The balance sheet is built on a paradox. It must report a company's exact financial position on a specific date, even though the real world does not pause for reporting cycles. To manage this, U.S. GAAP uses a classification known as a contingency. A contingency is an existing condition, situation, or set of circumstances involving uncertainty. The resolution of this uncertainty, whether it results in a financial gain or a financial loss, depends entirely on events that will happen or fail to happen in the future. These uncertainties appear as concrete business events, a pending judge's ruling on a patent lawsuit, or the statistical likelihood that a newly sold product will require repairs next year. The overarching accounting rule governing these unknowns is the conservatism principle. GAAP strictly partitions financial uncertainty to ensure financial statements reflect reality and avoid providing a misleading outlook to investors. The conservatism principle dictates an asymmetrical approach to uncertainty. Losses are recognized aggressively to prepare for the worst, while gains are strictly deferred until they are absolute reality. This matrix outlines the 3 U.S. GAAP probability thresholds used to categorize loss contingencies: remote, reasonably possible, and probable. A remote contingency carries only a slight chance of occurrence. Because the risk is negligible, the rules require no accrual and no disclosure in the financial notes. A reasonably possible contingency represents a chance of occurrence that is more than remote but less than likely. These events must be disclosed in the footnotes, but they are not recorded in the accounts. The highest threshold is probable, meaning the event is likely to occur. However, recording a liability requires a second condition. The amount of the loss must be reasonably estimable. If a probable loss cannot be estimated, it remains a footnote disclosure. If it can be estimated, a liability must be formally accrued on the balance sheet. We can see this in practice through a straightforward probable and estimable loss scenario. In this wrongful discharge suit, the company faces a $500,000 claim. The attorney advises that there is an 80% probability that the plaintiff will prevail and receive the full amount. Because an 80% chance is considered probable and the $500,000 is a precise estimate, the full amount is recorded as a loss contingency. Calculations are simple when there is a single number, but GAAP also provides rules for when a probable loss exists as a broad range. In this truck accident scenario, counsel provides an estimated range of damages between $250,000 and $500,000, noting that $400,000 is a better estimate than any other amount in that range. For ranges, GAAP requires companies to accrue the amount that serves as the better estimate. For Gary Corporation, this dictates a $400,000 accrual. If no single number in a probable range is better than any other, GAAP requires the company to accrue the absolute minimum amount of that range. Accruing the minimum of an unweighted range ensures a company captures its undeniable baseline liability. This prevents the overstatement of unproven maximum losses that could be used to manipulate future earnings. The framework shifts when we look at the potential upside, lawsuits the company is likely to win, or settlements they are owed. Gain contingencies follow a single strict rule, regardless of their probability. They are recognized only when fully realized. Consider this patent infringement case. While the company's attorneys expect a $5 million award, the matter will remain in litigation for 2 to 3 years. Despite the high confidence of the attorneys, the gain cannot be placed on the balance sheet. An ongoing lawsuit means the cash is not yet in hand. The gain is unrealized. Consequently, the correct accounting action for this $5 million probability is to record exactly $0, though the likelihood must be disclosed in the notes. This asymmetry protects shareholders. Recognizing an unrealized gain inflates a company's perceived value with phantom assets, which would prove misleading if the future event ultimately fails to occur. Product warranties are the most common continuous application of these contingency rules in corporate accounting. GAAP differentiates between 2 distinct types, beginning with the service-type warranty. A service-type warranty is a separate, optional purchase that creates a distinct performance obligation. The company accounts for this as unearned revenue, recognized over the coverage period. In contrast, an assurance-type warranty is built into the product price and cannot be separated. It simply guarantees that the product works as specified. An assurance-type warranty creates a standard loss contingency. Because the costs are probable and estimable, they must be accrued immediately at the time of sale. We can demonstrate these accruals through a 2-year warranty case study. This table tracks sales and actual warranty payments for year 1 and year 2. Based on past data, the company expects defects to cost 3% of sales in the first year and 5% in the second. Following the matching principle, the entire expected cost of the 2-year warranty, totaling 8%, must be recognized as an expense at the exact time of the sale. We calculate the year 1 expense by multiplying the $300,000 in sales by that total 8% expected rate. This generates an immediate $24,000 warranty expense. During that same year, the company makes $5,000 in actual cash payments for repairs. Actual warranty payments reduce the existing liability pool rather than creating new expenses. Subtracting that $5,000 payout leaves an ending year 1 liability of $19,000. In year 2, new sales create a fresh $40,000 expense, while $37,000 in actual cash payments drains the combined liability pool down to a $22,000 ending balance. By requiring companies to accrue total expected future costs on day 1, GAAP maintains the integrity of the income statement. This prevents a company from showing artificially high profits in the year of a sale, only to be strained by hidden repair costs in subsequent years. We can test this entire logical framework by evaluating a company managing multiple overlapping legal contingencies. Potter Company has 4 distinct legal contingencies on its ledger, representing a mix of probabilities and types. We first filter out the items that belong strictly in the footnotes. The $500,000 reasonably possible loss is disclosed but not recorded. Applying the asymmetry rule, both the $700,000 probable gain and the $300,000 reasonably possible gain remain off the balance sheet, though the probable gain is disclosed. This leaves one item triggering a hard accrual, the $1,500,000 probable loss contingency. This single multiple choice question validates the entire logical framework. It demonstrates how companies must publicly disclose reasonably possible threats, even when only probable, estimable losses actually impact the current financials. U.S. GAAP contingency rules function as a highly calibrated algorithmic defense mechanism for the integrity of financial markets. By mandating radical transparency on losses and extreme skepticism on gains, these standards ensure the balance sheet reflects a verified financial position amidst future volatility.